Thank you for joining us today. We're happy to have Jan Valeka here to talk about Social Security. Please post any questions you have in the chat and we'll get to them at the end of the program. So Jan is the owner of Valeka Wealth Management, a boutique wealth and investment management firm. Her financial career began at Morgan Stanley, and after 17 years in the industry, she founded Valeka Wealth Management. Becoming independent gave her the opportunity to offer comprehensive financial planning, objective investment advice, and customized strategies to her clients. As an industry veteran since 1988, she has had the opportunity to help guide investors over the last 3 decades. Her mission is to help you simplify your financial life with planning. So welcome, Jan. We're so glad to have you.
Thank you.
I'm going to turn it over to you, and I'll come back at the end for questions.
Thank you so much, Jennifer. I appreciate it. Thank you. And I want to welcome everybody for attending today. This is a very important topic, although my tagline is I like to help you simplify your financial life. Social Security is a complicated topic. So first today, I'd like to start with the brain teaser. And this is something to think about. We're going to circle back to this at the end of the session. In life, would you rather be early or delayed? And number 2, would you rather pay a penalty or get a bonus? This session is called What Baby Boomers Need to Know About Their Retirement Income. Savvy Social Security planning is what baby boomers need to know when you start to plan your retirement income and how Social Security is going to flow into your other incomes that you have during retirement. When your parents retired, they probably went to the Social Security office and applied for their benefits and didn't think too much about it. But baby boomers have a lot of questions and they think about Social Security differently now. And this is what this session is going to cover today. People are hurting their retirement by making terrible, costly decisions about Social Security. We're going to try to solve that challenge tonight. First, you might be wondering, why is a financial planner here to talk to us about a government program like Social Security? And I think that's a really good question, and I'm going to give you some answers. There's a big need for Social Security education. Boomers are very interested in the topic, as your own presence here confirms. Number 2, many uninformed people make damaging decisions about how to claim for Social Security. And poor Social Security decisions make my job as a financial planner more difficult when I have to help clients develop a retirement income plan to correct for unnecessary Social Security benefit reductions. I also want to make you 2 guarantees. Today, I'm trying to make you smarter about claiming for your Social Security benefits. And I believe after the seminar, you'll be better prepared to make a good decision. And then this is purely an educational event. I normally in an in-person event, I would have a handout, and Jennifer has this a handout. I'm sorry, she has the handout that she can email you after our seminar. I'm going to ask that as we talk, there's a lot of slides here, a lot of good information to cover. So I'm going to ask that you write down your questions as they come into your mind. And Social Security is very individual. So some of your questions at the end might cover all the questions that others have. But if it's something more specific, I can always get back to you. So Jennifer's going to monitor the chat session, and then I'll circle around at the end of the slideshow and I'll answer any questions. But first, we're going to start with the things to know about Social Security and the different claiming options that you have. You have many claiming options, and one couple could conceivably have up to 18,000 ways to claim on their Social Security. We often look at the 5 most important useful scenarios. Your decisions have far-reaching consequences. Most decisions are irreversible after 12 months. Your choice impacts both spouses. So a lot of people forget about this when they're deciding when to take their Social Security benefits, especially when they're married. Social Security is not bankrupt. It's not a Ponzi scheme. We're going to cover this later and go over some facts. And some of your friends and family may have already benefited from their Social Security benefits. At the same time, few of your friends have expertise on Social Security. So that's something to keep in mind. Baby boomers want to know. You've been told for years that the system's going broke, but now it's almost your turn to collect. And is it really true? You also want to know how much to expect before you retire. You've got to know how you're going to support yourself. So that means there's some work that you have to do. Doing a budget, lining up all your income sources, and knowing how much you can expect to receive from Social Security. Social Security is a relatively known quantity that represents the foundation of your financial plan. You're also probably asking, when should I apply for Social Security? You've heard that if you apply early for your benefit will be lower, but is it worth missing out on all those extra checks to have a higher benefit later in life? And what is your life expectancy? We're going to shed some light on this important question today. Something your parents probably never ask is it possible to maximize my Social Security benefits? There's absolutely nothing wrong with using the Social Security rules to your advantage. And that's what we're going to cover today is the rules of Social Security. And finally, you're wondering if Social Security will be enough to live on in retirement. You probably already know this, but the answer to this is Social Security represents 40% of the average retiree's total income. So by coordinating Social Security with the rest of your retirement income, you can pursue a comfortable, worry-free retirement. Understanding the value of Social Security, they think it will be a minimal amount. Most people think that Social Security will be a minimal amount, but Social Security is far more valuable than most people realize. Will Social Security be there for me? Lots of misunderstandings and irrational fears surround the solvency of Social Security system. Let's look now at a report that Social Security publishes every year showing the long-range outlooks for Social Security. Every year, it's OASDI, which stands for Old Age Survivor Disability Insurance. Every year, the Social Security system produces this report, and it's talking about how much money they have in the trust fund. Right now, the trust fund holds around 2.9 trillion, which is invested in special issue treasury securities. As baby boomers start retiring, and this is what everybody has come to the conclusion, these trust fund assets will gradually be drawn down. However, over the next 75 years, costs will begin to exceed income. Everybody realizes this, but sometimes this chart, I think, is telling to look at the numbers. There'll be enough reserves that the system will be able to pay 100% of promised benefits up until 2035. After that, if nothing is done to reform the system, there's a lot of bills before Congress, income will be sufficient to cover just 80% of the benefits of promised benefits. What would it take to restore solvency in the system? These are a lot of things that our Congress is working on and get presented, and then it gets voted on. But it's been talked about increasing the maximum Social Security subject to Social Security tax. Right now, it's currently $147,000. Raise the normal retirement age. We've done that once. And so it depends on the year that you were born on when you're claiming age. But the latest full retirement claiming age right now is 67 for those born 1960 or later. And then lower benefits of future retirees. No one really wants this, and that gets voted down every time, but it's to escalate the benefits based on increases in consumer prices rather than wages. And then reduce the cost of living adjustments, which is called the COLA. That's kind of important this week because at the end of the week, we get a CPI number, and we're going to get the COLA increase for 2023. And it's expected to be one of the highest that we've had in quite some time. So what's a clear way to think about, baby boomers, they are not likely to be affected that much at all. So we need to stop worrying about Social Security and will it be there for you in the future. What we need to start thinking about is what's a clear way to think about Social Security. Instead of thinking that it doesn't matter much and it's not going to be there for you, what's a smarter way to think about it? How can I maximize it? So we're going to go over 4 insights today, and this is the first insight. It's a straightforward definition that Social Security is inflation protected income, that even after your death, your benefit can continue in the form of a survivor benefit. And so that's why we want to try to maximize your benefit as much as we can. Your premium or tax is listed on your paycheck reported under FICA, which stands for Federal Insurance Contribution Act. You and your employers have paid this premium all throughout your working career. So you want to be smart about how and when to collect your benefit and know about its various features. Social Security offers income that you cannot outlive. It has nothing to do with the market. It's based on your life expectancy and when you decide to claim your benefit. If you claim your monthly benefit today and it's $2,000, in 10 years, you would have received $276,000. In 20 years, $602,000 in lifetime benefits. And if you live 30 years or more, over $1 million in lifetime benefits. Social Security offers annual inflation adjustments also. This is what I called earlier COLA adjustment, cost of living adjustments. As you know, inflation, this is year 2022, and inflation has been in the headlines. Everybody knows that. So normally there's a 2%, most of these figures assume a 2% cost of living, but we're about to have a large COLA adjustment of around 8%, I believe is the number that they're talking about. So a lot of people's Social Security and monthly benefit is going to be increased, and we'll know that number at the end of this month. But again, if you start your benefit at $2,000 today and you keep getting even a 2% COLA increase, in 30 years, your $2,000 today would be $3,623. So it increases as you get older and still while you're receiving benefits. So how much can I expect to receive? That's a really good question. Used to, the Social Security Administration would send out a report, but now you have to get it online. So we'll cover that a little bit later. But when your Social Security benefit is calculated, it's based on how much you've earned over your working career and the age at which you apply for benefits. How Social Security benefits are calculated. Now, this gets tricky. Most people really don't care for this because they give it to you on a calculation, but some people really want to know the nuts and bolts of how it's calculated. The formula for calculating Social Security is pretty complex. The general process goes like this. First, Social Security looks at your annual earnings over your entire lifetime. It indexes them for inflation and picks the 35 highest years of earnings to include in the formula. The indexed earnings are totaled and divided by 35 to come up with an average. If you don't have 35 years of earnings, the missing years will be filled in with zeros. And if you've ever done an average calculation, if you have zeros in there, it actually brings the average down. So this has an effect of lowering Social Security benefits for people who have taken time out of the workforce. This is very typical for women. They have taken time out of their career to raise children, or people that have taken off to be a caregiver for a loved one or aging parents. The effect of lowering Social Security benefits, affect you down the road, and it affects the COLA. The next formula, they take the average monthly earnings to determine your primary insurance amount. Primary insurance amount is the equivalent of your FRA, your full retirement age. This is the amount you'll receive when you reach full retirement age. It could be your full retirement age could be 66 or 67 or some age in between. Each year, COLAs are applied to your benefit to help you keep up with the cost of living. Here's an example of a benefit formula. This is a baby boomer born in 1960. They turned 62 in 2022. Their maximum Social Security earnings over the years since age 22 has been $11,433. This is the formula. A lot of people aren't that interested, but the Social Security on their website provides this information. They take that average earnings and then they apply bend marks to it. They break it down over 3 different calculations to come up with your total PIA, which is your primary insurance amount. This particular baby boomer, so they were born in 60, so their full retirement age is age 67. So at that point, they could receive $3,357. That's good to know. I know the calculation is a little bit quirky, and some people really don't care to know that. But shouldn't I claim early at 62 instead of delaying full retirement at age 70? How does that benefit me? Some people, this is where people start to get in trouble, and this is where I really want people to key in and listen to the data. This is insight number 2. Your monthly benefit will be reduced if you claim early. It's true that you can start claiming your benefits at age 62, but they're permanently reduced. They do not ratchet up. You do not get that money back. It may also be reduced for taxes and Medicare premiums, and the benefits could be withheld if you work. So when should you apply for benefits? Well, naturally, this raises a very good question on the timing of when you apply for your benefits. The decision of when to apply for your benefits is one of the most important and one of the most complicated decisions that you'll ever make. It literally can make a difference in thousands of dollars over your lifetime. And that's something that you really have to keep in mind, because when we're talking about your benefits, they're monthly benefits. But if you remember from previous slides, it's your lifetime benefits. And so that's what we're trying to have the focus on here, is your lifetime benefits. It's important to realize that the decision when applying for Social Security depends on factors such as health status, life expectancy, your need for income, whether or not you plan to work, because that can reduce your benefits, and then your survivor needs. Will Social Security be enough to live on at retirement? We answered this earlier when we said that Social Security made up about 40% of a retiree's livable income. So the answer is probably not. Social Security benefits alone will probably not be enough to live on through retirement. How your claiming age impacts your benefits can add to your income in retirement. Here's the breakdown of your claiming your full retirement age. If you were born before 1954, your full retirement age is 66. If you were born anywhere from 1955 to 1959, it's 66 in several months. So if you were born in 1958, for example, it's 66 in 8 months. And if you were born after 1960, it's a flat 67, age 67. What if you apply for early benefits? So these claiming ages affect the percentage of your full retirement if you claim early. So if your full retirement age is 66 and you want to claim early at age 62, they'll reduce your monthly benefit by it'll be reduced by 25%. If your full retirement age is 67 and you claim early, it'll be reduced by 30%. So these are really important numbers to know, is that claiming early is going to reduce the benefit. If you're 66 and you file it at age 66, you'll get 100% of your benefit. If you're 67 and your full retirement age is 67, you'll get that benefit 100%. It will not be reduced. These are prorated also. So if you end up applying in between these years, your benefit will be prorated. What if you apply after FRA? This is the exciting part, because each year that you don't file after your FRA, full retirement age, you earn an additional 8%, which is called delayed retirement credits. Apologize. I'm trying to keep up because it's important that I relay this to you. So if your full retirement age is 66 and you apply at 67, your benefit will be 108%. At 68, it'll be 116%, and so on. At age 70, it would be 132%. So this not only increases your monthly benefit, you're also getting those COLA increases. And it also is applying to your survivor benefits, which is the most important thing that we have to consider when deciding when to claim these benefits. Quick story. I heard somebody the other day that was telling a story that they had gone to somebody's funeral. They were 75, and he had learned from the family that he had never applied for Social Security. So at age 70, you earn delayed credits up until age 70. Your benefit grows. After age 70, it does not grow anymore. If you do not apply for Social Security at age 70, then that income is lost. You can only get retroactive 6 months back. So that was a really sad situation to hear of somebody 75 that had never applied for Social Security. They just never got around to it. It seems unreal, but that happens. And so this is a public service announcement of any of your friends. Once they hit 70, they have to start taking, they need to start taking Social Security. Social Security office is not going to reach out and say, hey, you know, we need you to apply. It's for you to know to do that. How to estimate your Social Security benefit. I'm going to spend just a little bit of time on this because the most important thing, and I even have a link on my website, you go to mysocialsecurity.gov, my account. You have to create a secure sign-in. It takes several steps. They make you change the password every year. But every year as you're working, they update your Social Security statement. This is the one that I said they used to mail to you. If you think about it, you don't get mailed this statement anymore. You have to go online and request it and look at it. They actually changed the design of it last year, so it's going to look a little bit different. But the important thing that I tell my clients is that when you look at your Social Security statement, you're not just looking at your, you know, your full retirement benefit, your age 62 benefit, their estimate on what your benefit would be at age 70. But you also want to look at the next page on your earnings statements, because you know, these earnings are reported by your employers and sometimes they're wrong. So it's really important that you get your benefit, your Social Security benefit statement, and review it and make sure everything is right on it and look at what the income is going to be. This keeps getting updated every year. So every year that you're working, they're updating it. If you've gone back into the workforce, they're replacing the zeros. So it's important that you have this account set up and you know how to look at it. They also have calculators, and you can actually calculate your benefit by putting in your work history. Please note that the annual statement does not reflect COLAs into your age 70 benefit. And so your actual benefit will be higher than they indicate once you reach that time. Why delay your benefits? Bigger checks to start. The obvious advantage to delaying your benefits is that your monthly benefit will be higher. Any boomer who has paid primary insurance amount of $3,000 and the full retirement age of 67 will receive $2,100 per month if you applied at age 62, but $3,720 if they waited until age 70. The difference will become even more dramatic if we multiply these amounts by 2% annual COLAs. If the cost of living adjustment is 2% every year over the next 8 years, his age 70 benefit jumps to $4,359. That's huge. That's a lot of ongoing benefits, especially with our longer life expectancies. It might be hard to pass up Social Security checks when you can start receiving them as early as age 62. But if you live a long time, you'll be very glad you waited. As you can see, the longer you live, the more income you'll have by waiting till age 70 to apply. So this is somebody that claims at 62, at age 70, let's look at age 90, their benefit would be $3,656. But if somebody had waited till age 70 to claim, at age 90, their benefit would be $6,477. That's quite a difference in the income at age 90 on the benefits. Okay, so naturally thinking, how can you maximize your benefits? These are all good rules, but how does it specifically apply to me? Number one, you can improve your earnings record. This is what I was talking about earlier about you need to download your current benefit statement. You need to look at your earnings. I had a lady once that was looking at her earnings and noticed that 1984 was blank. Her employer never reported it. So she had to go to the Social Security and, have that updated. But that was important because it replaced a zero, which is really important when you're looking at that average annual, your 35 best years. Is it accurate? Any missing years? Can you improve it by working longer? Yes, you can improve it by going back to work and working longer. Something else I wanted to point out, self-employed individuals, it's really important that you check this number also, because when you're self-employed, your earnings are not being reported by an employer, it's being taken from your tax returns. So you need to be sure that everything is accurate. And then if you go back to work and you replace the zeros, that's always a good thing. Even if you start receiving Social Security but continue to work, your earnings record will be updated. However, it's important to know that receiving Social Security before reaching full retirement age, and if you earn over a certain amount, those dollars will be withheld if you're over a threshold, which is called the earnings test, and we'll cover that in a second. So applying for Social Security benefits at the optimal time is the best way to maximize your Social Security benefits. The chief reason for delaying is because that will result in the highest lifetime for you and your survivor. So we're always wanting to focus on the survivor as well. But there's no one size fits all to this. And the important thing is apply at the time that's optimal to you. The tax benefits, the taxation of benefits. Did you know that Social Security benefits may be taxable? Let's look at maximizing your benefits, but minimizing your taxes. That's where it becomes tricky. This is very important. So while the earnings test isn't truly a tax, it's a way in which the government takes back some of your income. So we're including this in this discussion, but it's different from the true taxation of benefits, which we'll get to next. One important consideration in deciding when to apply for benefits is whether or not you plan to work. If you apply before you turn full retirement age in 2022, $1 in benefits will be withheld for every $2 you earn over $19,500. Now it's important to know that this money isn't truly taken away. Rather, your benefit will be adjusted upward when you turn full retirement age to make it as if you had applied later. This means that if some of your benefits are withheld due to earnings test, your new benefit will be higher as if you had started at 63, 65 instead of 62. Please don't let the annual earnings test discourage you from working, because the fact is the more money you earn, the more money you have. Social Security does not penalize you for working. Once the adjustment is made, you will end up with a higher benefit for the rest of your life. And of course, the earnings themselves will contribute to your financial well-being. To avoid the earnings test entirely, just wait until your full retirement age or later to apply for benefits. And this will take this out of the equation. So we had the earnings test, which would withhold some of your benefits, although you would get those back later. Now we have the taxation of benefits, which is actually taxing your benefits where you do not receive that back. The true tax on Social Security is based on various income levels. Income in this case means provisional income, which includes adjusted gross income. So after the seminar, if you're home and pull out your tax return, you can actually find your AGI, your adjusted gross income. It's your dividends, capital gains. There's other things that flow into your adjusted gross income, plus 1/2 of your Social Security benefit, plus any tax exempt interest. So if you had tax-free municipal bonds, they're not taxed from the federal level, but they go into this calculation on deciding if your Social Security benefits are going to be taxed. If provisional income is under $32,000 for a married couple, benefits, no benefits are subject to tax. But if provisional income is $32,000 to $44,000, then you're taxed up to 50%. And anything over $44,000 for a married couple, you're taxed at 85%. If you're married, filing separately or living with a spouse, it's a straight 85%. They skip right over the 50%. It's a straight 85%. It's important to remember here that up to 85% of your Social Security benefits may be subject depending on how much other income you have. So this is where financial planning comes in, is that you look at all the other income sources to know what your tax is going to be. And they call this a tax torpedo. When you have other income coming in, and then it causes your Social Security tax to be taxed, your Social Security benefits to be taxed. Ways to minimize your Social Security, the taxes on your Social Security benefits. You can minimize taxes on Social Security by lowering your income, especially your investment income. But you should be aware that municipal bond interest, which is usually tax-free, counts as income for the purpose of calculating your Social Security benefits. And you need to anticipate the required minimum distributions from your IRA, which cause you to be in a higher tax bracket and may cause some of your Social Security earnings to be taxable. This has really become important because when we first started out, saving for retirement, we put a lot of money into 401ks. And then when you retire, you roll those over into an IRA. The government will only let you defer that money until age 72. It used to be age 70 and a half, and they just increased that a couple of years ago. So once you hit age 72, if you have a large IRA, it's based on your life expectancy. They actually make you take money out, and they issue you a 1099-R, which is taxable income. Well, if your taxable income comes in and you're also receiving Social Security benefits, then that could cause you to pay more taxes on your Social Security benefits than you were before age 72. So what a strategy that a lot of people start doing, like in their 60s, is that they start converting some of their larger IRA assets into a Roth IRA. You have to pay taxes on it on the year that you convert it, but it's a strategy to reduce their taxes on their Social Security benefits later in life after age 72. Also, delaying Social Security reduces the number of years that your benefits are subject to tax. And you can reduce your expenses and pay down debts and adopt a similar lifestyle. And then you continue to manage your taxes throughout retirement. I'm going to give a caveat and a disclaimer here that I'm not a tax accountant. And we would suggest that you always discuss this with your tax person. Medicare is important also, because when you turn 65, more than likely, if you're not still working and covered by a plan, you'll enroll in Medicare. And Medicare has a premium. Most people don't realize that premium is taken out of it's a Part B premium, and it's taken out of your Social Security check. So in 2022, the Part B premium is $170.10. That's the minimum premium. It's based on your annual income. So I think the highest premium is like $463. This premium actually was just reduced. I think it's going to be $164 going into 2023. But depending on when you claim your benefit, that premium is going to eat up more of your benefit. So if you wait to claim at age 70, it only eats up about 5%. If you claim at 62, it's eating up about 9%. I'm surprised that, well, maybe not surprised, because this is a once in a lifetime thing when you when you start Medicare and then you apply for your Social Security benefits. But a lot of people are just looking at that benefit statement, and they don't realize that their Social Security is going to be reduced by these Medicare premiums. And the income that they're earning right up into the point that they apply for Medicare is also going to affect it. It stays on the books for 2 years. So it's an important thing to consider. Okay, when to apply for your Social Security. The question's very complex, and it really requires a customized analysis, and that's what a financial planner does for you. But here's a few points to remember. If you apply early, your benefit starts out at some fraction of your PIA, 75% or 80% or whatever. It remains at the percentage for the rest of your life. So if you start early, it's a permanent reduction. It does not go up to 100% when you reach full retirement age. COLAs magnify the impact of early or delayed retirement benefits. The annual cost of living adjustment is applied to either the lower or the higher amount. This causes the disparity to increase with each passing year. Your benefits may be taxed and further reduced by Medicare premiums. Always remember this. And don't let the earnings test discourage you from working. It's actually helpful for many to continue to work. It's more money that you have. And finally, delaying benefits gives the surviving spouse more income later in life. That's an important point to consider, especially if you're thinking about something like this. I'm not going to live so long, so why shouldn't I just claim my benefit while I can? I actually get this question a lot from the men. They come in and say, oh, my father died of a heart attack, early, like in the 70s. If I wait, I'm not going to get anything from Social Security. But it's a strategy that we use for married couples to kind of talk through, and that's where the Social Security analyzer kind of takes those payments out over your lifetime and kind of shows you the benefit of waiting. So this is insight number 3 for couples. You should always maximize the higher earner's benefit to protect the surviving spouse. What we mean by this is the higher earners are therefore encouraged to delay their benefits to age 70 because that will give their spouses the highest benefit after they die. First, let's start by looking at how the spousal benefits actually work. This is a spousal benefit equals half of the primary worker's PIA, their full retirement age benefit, if started at full retirement. John's PIA is $2,000, Jane's is $800. That's based on her own work record. If Jane applies at her full retirement age, her benefit would be $1,000. That's $200 more than her benefit based on her own record. So she can do that because her benefit is lower than John's. Also, I want to point something out here. We're using wives in our examples, but this is still, but it's either or. It's either gender and for same-sex spouses. And so this applies across the board on spousal benefits. I wanted to make that point. We use wives in the examples because actually statistically, that's the most common scenario. And that's from the Social Security organization. The spousal benefit is 50% of the workers. And so we need to keep that in mind that in that example, she would get 200 more. Now, the rules of the spousal benefits, the primary worker must have filed for benefits. The lower earning spouse must be at least age 62 for reduced benefits, or FRA, full retirement age, for full benefits. Remember, that's if you're born after 1960, your full retirement age is 67. And then spousal benefits do not earn delayed retirement credits. So I'm sure you have a lot of questions about spousal benefits. So let's look at some ways to maximize them. You want to coordinate your spousal benefits. The goal is to maximize the income for both of you and maximize the income if one of you dies. And so this is a consideration you always have to be cognizant of. And by understanding all these different variables, it helps you make the right decision. So this is a maximization strategy. The first thing to look at when you're coordinating spousal benefits, and this is where getting your benefit statement is important, the lower earning spouse's PIA is at less than 50% of the higher earning spouse's POA. If they're equal, if both spouses have had careers and they've worked and it's equal, both spouses should delay to age 70. And you maximize your lifetime benefits over the average or the long-term life expectancies. A hybrid strategy is where the lower earning spouse's PIA is less than 50% of the higher earning spouse's PIA. So in this strategy, you would have the lower earning spouse claim early and the higher earning spouse delay and get the delayed retirement credits, the 8%, until age 70. This generates income sooner while maximizing the higher earning spouse's benefits over both lifetimes. So In my practice, and this slide is just in here, it's part of the presentation. We have a way of doing a customized Social Security spousal planning analysis where we take your benefit statement, put in your age, your date of birth, your benefit amounts, and then we run an analysis. So I would highly suggest you do this, or if you're working with somebody, you have them run a Social Security optimizer analysis. Okay, so while I'm already widowed or divorced, so how does that impact my Social Security claiming strategy? This is a really good question because there's so many people now that have gone through this situation, and it does play a big impact on your Social Security claiming strategies. So insight number 4, if you're widowed or divorced, you may be eligible for survivor benefits or divorce survivor benefits or divorce spouse benefits that can increase your monthly check. Let's go over some of those. On your survivor benefits, there's 2 key factors. They're somewhat complicated, but it's important to understand how they work because the decisions you make can influence your amount and make a big difference in your benefits. 2 factors that influence the amount of the survivor benefit. The first factor is the age at which the deceased spouse claimed his own retirement. If he or she originally applied for Social Security before full retirement age, the survivor benefit will be limited to his or her actual benefit at 82% of full retirement age, PIA, their primary insurance amount, whichever is higher. If the deceased applied at his full retirement age, the survivor benefit will equal 100% of the primary insurance amount. If he or she applied at 70, the survivor benefit will include delayed retirement credits. And we'll see that in an example in a moment. These are important points to remember. Number 2, the second factor influencing the amount of survivor benefit is the age at which the widow or the widower claims the survivor benefit. If he or she claims at age 60, 50 if they're disabled, the survivor benefit will equal 71.5% of the decedent's PIA, which would have been their full retirement age. If he or she claims at full retirement age, this is talking about the widow or widower, at their full retirement age, let's say they were born in 1960, so that would be 67, the survivor benefit will equal 100% of the original amount. They may apply anytime between the ages of 60 and 70, and the reduction will be prorated. I have a client that her husband died when they were in their 30s. And so now she's 60, she's a school teacher, she's up in New York, so she has a pension. Her full retirement age is going to be age 67. And at 67, at her full retirement age, she's going to be able to apply for a survivor benefit and collect his PIA for 3 years until and keep earning her delayed retirement credits on her benefit, and then switch over to her full retirement to her age 70 with all the delayed retirement credits, and then have the higher benefit for the rest of her life. And so that's why this is really important to know for widows, to understand how this works. This is really important also, and I've been surprised by this, that a lot of people don't realize. One important note about the survivor planning is the loss of one benefit. Most widows and widowers need at least 2/3 of the amount of income they were receiving as a couple. So it's important to plan for the loss of one spouse's Social Security benefit, even though it is often the higher benefit that will be returned. You always step up into the higher benefit. The death of one spouse means the loss of one Social Security benefit. So you're going along, you have 2 incomes coming in, you step into the higher, but you still lose the lower benefit, which means less money coming into the household. If the spouse dies while both are receiving benefits, the widower may switch to the higher benefit. Joe and Julie are married, both are over full retirement age. Joe's benefit is $2,800, Julie's benefit is $1,500. Joe passes away. Julie notifies Social Security and her 1,500 benefit is replaced by a 2,800. She gets Joe's benefit of 2,800. So this is an example of delayed claiming. Joe and Julie are married. Joe's PIA is 2,800. He delayed claiming to age 70, so his benefit is 124% more of the 2,800. So he's earning 3,472. Joe dies. Let's say Joe passes away like at age 75. Julie's survivor benefit now will be the 3,472, not the 2,800. So this is really important because she's going from 2,800 to 3,472 if he would have delayed the retirement credits. And so that's where the COLA and delaying really makes a lot of difference for the spouse's standard of living later in life. And as we know, it's just it's just a statistic that women outlive men. And so their life expectancy is longer. And so that's why men really need to consider this when they're deciding when to claim Social Security benefits. It actually needs to be a joint, decision as a couple on how you're going to strategize and get these benefits. Because I've had widows come into my office before that had no idea that one of the benefits went away. They thought that Social Security was for the rest of your life, which it is if you're still living. But if you have joint, two incomes coming in and one goes away, that's really going to hurt your standard of living. And this is what we want to prevent. And this is what the education piece is about. So rules for the survivor benefits. In order for the surviving spouse to receive survivor benefits, the marriage must have lasted at least 9 months, except in the case if the death is ruled an accident. The survivor must be at least age 60 or 50 if disabled, or full retirement age for the full benefit. This is what we would normally recommend, or the benefit will be reduced. If you were married before age 60, you will not be able to receive a survivor benefit based on your previous earnings, spouse's earnings records, unless your remarriage ends. And divorced spouse survivor benefits are available if the marriage lasted at least 10 years. Let's look at this a little bit more, since many people have been divorced and it's not widely known or understood. It gets complicated. So I'll say this. Remember Johnny Carson? I think he had 4 wives. I think 3 collected on his Social Security benefits. Here's the rules for divorced spouse benefits. More than one ex-spouse can receive benefits on the same worker's records. If your ex-husband or wife has remarried a couple of times, all 3 exes can claim divorced spouse benefits, as long as each marriage lasted more than at least 10 years. The benefits paid to one ex-spouse do not affect those paid to the worker or to the current spouse or the other ex-spouse. It has no bearing. They get the benefit. You do not need to know your ex-spouse's whereabouts, only enough identifying information that Social Security people can look up his records. Also, you need to provide documentation showing the dates of the marriage and divorce. So this goes back to, people ask me, how long should I keep records? How long should I keep tax records? Divorce, marriage certificates, death certificates, adoption, all those records you need to keep. They're very important. If you're receiving divorced spouse benefits and if you remarry, your divorced spouse benefits will stop. However, then you may be eligible for spousal benefits based on your new husband's work record. Or you can switch to your own benefit, of course, if you qualify for Social Security. You're always going to be looking at that, and you're always going to go with the higher benefit. If your benefit is higher, you're always going to go with your benefit. Interesting. And so this is what I just covered. I apologize. Gee, this is really complicated. This is really more complicated than I realized. I agree. It really is. And people don't realize that a lot of stuff, and I didn't realize this either until I educated myself. And I've been on a million of these educational for financial planners, and it's not a one-time listen to it and then you understand it. It's listening to it, applying it to your own personal situation to see if it really works. It is very confusing. So if you're lost at this point, you're not alone. Which brings us back to our Social Security, our brain teaser at the beginning. So after we've gone through this presentation, you may have heard the phrase behavioral finance. It's big in the financial planning community now. It's the study of the influence of psychology on the behavior of the investor. So for our brain teaser question, some people would say they'd rather be early than delayed for many things in life. And they'd rather get a bonus instead of paying a penalty. That makes sense, right? It totally does. But we've seen in our presentation, when it comes to Social Security claiming strategy, early is a penalty as delayed is to a bonus. The government didn't set the phrasing up this way intentionally, but it certainly has influenced people over the years that have seen their claiming choices described as early and delayed. And people always want what's coming to them. Why not start it early? I'm going to get those benefits. I might die early. But we don't normally see the claiming question positioned as penalty versus bonus. But I think you can see the value of framing the question in that manner. I think this little brain teaser is a good way to loop back to our original problem, to review what we've learned, and then close with the solution. So here we go. People are hurting their retirements by making terrible, costly decisions about Social Security just because they didn't realize. So these were the key insights that we went over today. 4 insights designed to help us with a better understanding of Social Security. Social Security is inflation protected income you can't live. It's different than your 401k that's invested in the market or has any kind of market or interest rate exposure. It's actuarial. It'll be with you for the rest of your life. So it's inflation protected income because of the COLAs that you can't outlive, including survivor benefits. Your monthly benefit will be reduced if you claim early. I think we've made that clear in this presentation. Couples should always maximize the higher earners benefit for the spousal, for the surviving spouse. You always have to have this in mind. And if you're widowed or divorced, you may be eligible for benefits that can increase your check. Some people don't know this. My client that had been widowed in her 30s, this was newfound money for 3 years. It's going to equal about $75,000 that we found by just kind of looking at this and strategizing on what was her particular situation. Has she been remarried? No. And is she eligible for this? Yes, she is. So the understanding of that problem brings us back to this solution. Everyone needs a personalized Social Security claiming analysis to understand how and when to apply and how their monthly benefit will fit into their overall retirement income plan. Consider Social Security in the context of your other retirement income sources, including pensions, IRAs, 401ks, and your required minimum distributions that you'll need to have to start taking out of your IRAs at 72. Your overall investment portfolio and your plans for working in retirement. That factors into it also. Should be coordinated to give you the income you need for the rest of your life. Please don't be afraid to ask for help. Retirement planning is easy when it's a matter of stashing part of your salary into a 401k. That's automatic. That's easy to do. But when the time comes for you to convert your nest egg into an income stream, you want to make sure that it doesn't run out. So Social Security may be the bedrock of your retirement income plan, but it must be coordinated with your other resources to give you the stability and the security that you deserve. So this is very important. There's another public service announcement. What Social Security personnel can and can't do. They can't, it's a government agency. You have to remember that. They're understaffed. They're way understaffed. They can estimate individual benefits. You get that from your statement. And they can tell you the amount that you're entitled to now. I have a client that has been taking a spousal, and she turned 70 in January, and she's trying to reach them to say, what is my benefit going to be in January? They can't tell her. They can't project future benefits through scenario planning like a financial planner can, and they can't help with innovative strategies designed to maximize benefits. Like my client that was widowed at 30, they're not going to tell her, hey, by the way, at your full retirement age, you could actually collect your husband's, survivor benefit for 3 years before you turn your benefit on at age 70. They're not going to come up with these strategies. So that's why it's important that you work with somebody and you look at these strategies and scenarios yourself to try to maximize your benefits. And with that, I am going to ask, we've covered a lot of ground today, but you probably still have questions. When should I apply? What if I want to keep working? What if I've already applied? Because there is a 12-month period where you can reverse that. If you've made a decision and you're just like, oh, maybe I should have waited. There's only 12 months that you can kind of correct that. How much will my benefit be? How can I coordinate spousal benefits? What's the best long-term strategy for my situation? What do I do next? Social Security is too important for guesswork. We can help you protect your nest egg and maximize your income in retirement. So with this, I mentioned this earlier, I can provide a customized Social Security spousal planning analysis. If you're working with somebody, you have a trusted contact, they can do this for you as well. And at this point, I wanted to open it up for any questions. I'll check with Jennifer to see if we have anything. Go ahead, Jennifer. I'm sorry.
I was going to say, we don't have any in the chat yet. Please post them if you have questions. I do have a question, but finish your thought first.
All that I was going to say is that I was just going to thank everybody for coming. And I look forward to answering any questions. If there's any real complicated, specific questions, I can always get back to you. Jennifer's going to provide you with my email and my website in the chat. But I also wanted to mention, I love educating people. I love to educate people about these important claiming decisions with Social Security. And so I love to be a guest speaker. So if you ever need me as a guest speaker, please reach out for those reasons as well. Okay. Thank you, Jennifer.
Yeah. All right. So here's my question. I think this might apply to some people in our audience, as we're all city employees. So what if I paid into Social Security at some point in my life, but my current employer, such as the city, does not pay Social Security because we have a pension? Do I still get to claim Social Security for the years I paid in?
That's one of the tricky questions. But yes, it's actually called a WEP. So if you, for example, my dad was the same way. He worked for the railroad, so he didn't have Social Security. He had railroad retirement. And a lot of teachers fall into this also because they've taught and didn't pay into Social Security, but then they left teaching and then they had a job where they were paying into Social Security. There's a calculation, again, if you go back to Social Security, the website that I was talking about, where you can do the calculation. I'll just say this, and this is the easiest way to answer it. You do get that benefit, it'll be reduced. And it's a calculation that they put in to reduce it. So I'm happy. I have some pieces that deal specifically with that on when you have a government pension and then you also have paid into Social Security. And I'm happy to share that with you. But it is a reduction in your Social Security benefits. And the Social Security Administration, once you start claiming benefits, they do that calculation for you. And then annually they update how much your pension is, because that gets indexed for inflation also with COLAs. And they're always recalculating that to see if you're still receiving that pension benefit. Great question.
Perfect. All right. Well, it doesn't look like we have any more questions and we're at time. So I want to say thank you very much for joining us today. And I hope that you got some good information. We did record this presentation and we'll post it to our YouTube page in the next week or so. So you can watch it again as many times as you need to. Tomorrow, you'll receive an email link with a quick survey. The information that you provide on the survey helps us plan for future presentations. And then our financial planning lunch and learn series will return in 2023. So keep an eye on our website, fortworthlibrary.org, for more information. And thanks again, Jan. This was really great. I appreciate it.
Thank you, Jennifer. I appreciate it. I loved it.
Have a great day. Bye-bye.
Bye-bye.